Hello and welcome to Market Domination. I'm Josh Lipton alongside Madison Mills, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The economy's doing fine, so I don't think that, believe it or not, I don't think the economy needs a rate cut at all. But I bow to the will of the Fed, and they I think will deliver 25, not 50 in September.
The Gen AI trend is a very transformational one that has been rewarding to some of the enabling technologies in the course of the last 18 to 24 months. And you've seen that crystallize into significantly higher earnings expectations and outcomes. What we're seeing now is a little bit of an adaptation in hyperscaler CapEx trajectory. And so we still see a lot of investment coming from those hyperscalers into chips and into the AI trend.
Well, I think the themes we've seen have been pretty consistent across the space, which is better streaming profits, but that's come with larger linear losses. And so the trade-off that the street's looking at in aggregate across these companies, isn't super bullish. The one thing that I would say that we keep looking at is not so much the net ads or the profits. What I keep focusing on is what is the consumer paying to spend an hour on any one of these apps?
All right, we've got 1 hour to go here until the market close. We're taking a look at the major indices right now. And you know what, Maddie, kind of relatively calm now with 1 hour to go. Heading into the weekend, seeming kind of calm, kind of found our footing, and we deserve some calm. It has been a wild week. You started off on Monday, red everywhere, panic, hair on fire. There was different reasons for that. We've talked about it. There's technical, the yen-funded carry trade, but also a growth scare.
Yep.
All of a sudden people worried about, is this cooling economy going to go cold, and hot talk about emergency cuts. But then kind of found our footing, and some positive economic data helped throughout the week, sure. initial claims. And suddenly, I think, at least right now, investors seem to be thinking, you know what, maybe that soft landing is base case after all.
Yeah, it's so true. It's fascinating to see. I was just pulling up the 5-day so that we could take a look at the beginning of our week. Let me go over to the Nasdaq here and pull up the 5-day chart, because you can really see what a ride it has been up to the top. But also, right before our show, the VIX did pop below 21. So it is starting to get closer to where it was before this wild ride all began. Let me pull up the intraday so you can kind of see how the VIX is doing in terms of that downward movement, indicating that volatility is starting to normalize after a really tough wild ride of a week. I'm also looking at the 10-year popping below that 4 handle. That's going to be something to watch for our home buyers out there. And of course, to see how the bond space is going to inform equities moving forward. Certainly something we can talk about with the Zillow CEO later on. And then, of course, Bitcoin. We got a big interview on that coming up.
We got a big name coming.
Big day coming, yes, and a big move when it comes to the Bitcoin space too. But for more on this week's wild ride here, we want to welcome in our first guest. We've got Mark Lucchini, the Chief Investment Strategist at Janney Montgomery Scott. Great to have you on. So listen, when I look at what's going on in the markets here with Josh, it's looking like, did this all matter? Was this much ado about nothing over the past 7 days here?
Well, imagine as we sit here on a Friday afternoon after 3 o'clock, and had you not known what had transpired over the course of the week, you would think that basically nothing had happened. We're down a couple of tenths of 1% on a week-over-week basis at this juncture. We know it was Dramamine-inducing activity over the course of the week on a couple of things that I think are certainly worth monitoring as we go forward. I don't think we're necessarily wanting to be overly complacent with regard to certainly the jobs report we got on Friday, although Thursday's weekly claims number gave some assurance that perhaps companies aren't shedding workers quite to the same degree as the weakness that was attributed to the jobs report suggests that they might be. In addition to that, the unwinding the carry trade seems to be in its later innings, and an official from the Bank of Japan came out and seemed to have calmed fears with regard to any further activity on the part of the Bank of Japan that would jar markets any further. And so, collectively, I think we're ending kind of where we're beginning, which which is to say the economy continues to look like it's in pretty good shape. The Atlanta Fed GDP Now tracker is coming in at 2.9% for activity here so far into the third quarter, which is a continuation of a reasonably good economic climate that should be fertile for stocks. So it's no surprise that we've seen, a rather impetuous, perhaps, rebound in equity prices by way of yesterday's activity, but something at least allowing investors to take their breath.
It was interesting, Mark, because earlier in the week when there was that, Monday, there real sense of panic there, red everywhere. You heard a lot of criticism of the Fed, Mark. I mean, people were really out there, even pounding the table. All right, maybe we need an emergency cut. Jay Powell has screwed this up. The Fed is behind the curve. They should have lowered faster. It doesn't sound, Mark, like you're in that camp, though.
No, not at all. In fact, I think they could have actually exaggerated the crisis of the moment had they acted or came out and made some statement, even if it was an effort to calm the markets, because I think the markets might have interpreted that it was something that had gotten their attention, certainly, and warranted some comment to suggest that perhaps something even more nefarious was taking place behind the scenes that wasn't obvious to market observers. So, no, I'm assured by the fact that the Federal Reserve, one, didn't act by adjusting rate policy, or two, have to come out and make some commentary relative to the activity and really allow for the markets to settle down once I think cooler heads prevailed with regard to the activity that, at least so far, hasn't manifested into something that looks particularly sinister. And in fact, is probably what to be expected. One, we're in a seasonally weak period for stocks, August and September, and we haven't seen the kind of volatility nor a drawdown that was around 10% on a year-to-date basis, which is highly unusual. So this is more normal and customary. Sentiment got a little bit too extreme to the enthusiastic side, and that had to be reset. And we've gone through a pretty quick reset of that, but nonetheless, I think it's a setup for calmer markets to prevail.
Is this sentiment reset a buying opportunity? And if so, where's that opportunity?
Well, I think it is, largely speaking. I do expect further volatility over the next couple of months. The presidential cycle analogs suggest that we continue to see some weakness here leading up to the election. In addition to that, there is still, I think, some concern that is worthwhile noting that the economy is beginning to moderate. The job market is cooling, so we'll have to continue to watch the data that suggests that the labor market remains relatively healthy. So at the end of the day, though, while we're not abandoning those sectors that have been leaders on a year-to-date basis, namely some of those great iconic brands in technology, communication services, and consumer discretionary, we are suggesting to investors that perhaps they continue to bolster their portfolio by adding positions or taking an overweight in sectors like real estate and in healthcare and utilities, more classic defensive sectors, as a means of balancing out the risk in the event we do see further moderation of growth that does suggest that some of the risks that suddenly have risen around the prospects of a recession ultimately become validated.
Mark, I got to ask you about the election. Got to talk about politics for just 1 second, Mark. The election impact on the markets. When clients ask you, Mark, what do you tell them?
Well, at the end of the day, for long-term investors, they really don't have a substantial influence on the markets. I mean, certainly we've seen a lot of positioning and posturing with regard to sectors that might outperform or underperform relative to who the candidate might be. Obviously, so much not only depends on who's occupying the White House, but the composition of Congress, and as well the economic backdrop that persists at the moment that a changeover in the administration takes place. So I want to try to front-run that activity, a focus on the long term, and allow your asset allocation to help to weather, by way of risk management, the inevitable moments in time where investors will become, flustered over some comment being made by a candidate or some policy initiatives that, at face value, might look potentially disrupting for the markets, and focus on the long term, where over time we know investors have been rewarded for staying the course through any potentially climatic or intermediate term influence on markets that have a political orientation in their nature.
All right, Mark, we're going to have to leave it there. Thanks for joining us. Really appreciate it.
Sure, thank you.
We're going to take a look at one of our top trending tickers on the Yahoo Finance homepage now. And And we're going to start with Unity. Shares are climbing after beating earnings projections. They're up over 8% right now. Now, as a reminder, this is the company making software. It can be used to do things like make video games, graphics, even apps. And the company posting a narrower quarterly loss and a better revenue forecast. But interestingly, when you take a look under the hood, there's a little bit of a discrepancy here. And that's why we saw Wedbush still maintaining their outperform rating, Josh, but a change in the price target to 21 bucks a share, down from 33.50. And the reduction in guidance from Wedbush is specifically about market share gains that they're anticipating from a competitor in the space called AppLovin. That's something that they're concerned about. Having said that, it seems like Wedbush's call here is a little bit of an outlier when you take a look at some of the other reaction that we are getting from analysts. Oppenheimer, for example, putting them at a perform, saying the updated annual guidance does imply growth moving forward. They applaud the catch-up investment in their growth segment. Citi also maintaining a buy, but mentioning that the lowered 2024 revenue and adjusted EBITDA is a more cautious approach than they had anticipated.
Yeah, and you had a change in the C-suite too here, by the way. We should mention the CFO, Luis Visoso, has chosen to exit the company. Senior accounting officer filling his role, it looks like, while they now conduct an intensive search. Over at Wedbush, the analyst there, Michael Pachter, of course, longtime analyst, been covering gaming for a long time, saying he likes the CFO very much, but understands the desire of CEO, that would be Matthew Bromberg, to revamp the company and gain a fresh start. Pachter tells his clients still does rate this one outperform.
Interesting.
All right. Yeah. We're just getting started here on market domination. Coming up, Bitcoin prices rising back above 60,000 today. We're going to speak to MicroStrategy's very own Michael Saylor on the other side, get his thoughts on the crypto sector. Plus, a new head of the household, Zillow, announcing this week that longtime executive and chief operating officer Jeremy Waxman has been promoted to chief executive officer. We're going to speak to Mr. Waxman later in the hour.
And how sweet it is to be Sweetgreen, at least today. You're looking at shares of that restaurant chain up over 28% on the back of their latest earnings print. We're going to speak with Jonathan Neiman, Sweetgreen's co-founder and CEO, in the 4 p.m. hour. So all that and more when market domination returns.
Bitcoin recouping some of its losses from earlier in the week. The cryptocurrency trading above 60,000 as the crypto market tries to find its footing from Monday's sell-off. Bitcoin bull MicroStrategy Executive Chairman Michael Saylor joins us now. Michael, it is great to have you on the show. I want to start, Michael, with just the moves we saw this week. You know, we're rallying here now, briefly top 62,000. We did have that sell-off, though, early in the week, Michael. I'm just curious what you think explained that. What was going on there? Was that just, investors see Bitcoin as a very speculative asset? Was it margin calls? What was going on, in your opinion?
Bitcoin is the only truly global capital market in the world. And so if you think about the volatility of it, the volatility is the price that you pay in order to create billions of dollars of credit and liquidity at your fingertips, all times, everywhere, for everybody. On Sunday night, all the other capital markets are closed. Bitcoin is the only capital market that's functioning. What you saw over the past week is that it's functioning really, really well. And that is the secret to the success of the asset class.
Let me get your thoughts, Michael, though, on the critics are out in force, right? You know that. Column from the Washington Post, and the title was, "When Markets Get Scary, Crypto Proves Its Worthlessness." And talking about that sell-off early in the week, Michael, the columnist goes on to say, Bitcoin dropped by 15%. This is not how a hedge against inflation or disaster acts. Give me your response, Michael, to that.
Volatility is a sign of high energy. Rivers, waterfalls, fires, windstorms, they're volatile. They have massive amounts of energy. Niagara Falls is a scary place. If you're going to play in the pool, 5,000 people have died in Niagara Falls playing with it over the past 100 years. But it generates 5 gigawatts of power. That's 7 million horsepower. That's 33 million people working as hard as they can. So if you're going to harness the energy as an engineer, then you want the volatility. And if you're a tourist and you're playing in the water, taking selfies, then it's scary. No one that understands Bitcoin is afraid of the volatility.
Okay, well, Michael, I want to switch gears a little bit because crypto has sort of become this political football, this election cycle. I'm curious, are you advising either candidate or either campaign on crypto policy?
I'm advising everybody in the world that Bitcoin is digital capital. There's a revolution in the global capital markets, and traditional finance operates, 19% of the time for 10% of the world. That makes it a 2% solution. Bitcoin's a 100% solution.
Michael,
it's not partisan.
Michael, sorry
it's just
to cut
a good
you off.
idea.
Let me just be a little bit more direct with you. Have you spoken with either Vice President Kamala Harris or former President Trump specifically?
I speak with both Democrats and Republicans.
Have you spoken to either of them in the past, say, month?
Yeah, I don't share my conversations that I have in private and confidence with anyone in the world.
Okay, fair enough. Let's say that you were on a hypothetical phone call with either of them. What would you be telling them that your dream is for crypto policy moving forward?
The future is digital, right? There's a race to own cyberspace. That being the case, empires are built on productive property, and they're defended by firepower, naval power, air power, nuclear power, and digital power. Bitcoin's digital power. You want Bitcoin, you want to own cyberspace, you want the most digital power, just like you want nuclear power, air power, and space power. It's a good investment. It's like buying Alaska or like the Louisiana Purchase. And it's also essential to national security.
Which candidate is better for crypto?
I think that, again, crypto is, I'm not going to comment on anything political at this point. I'm going to say it's just a good idea to support digital assets and digital capital for any nation state, any political party, any politician. It will be a factor in November in the elections, I have no doubt.
I won't try to get you to comment on anything specifically political, Michael, but I am interested to get your take on this, which is that it does seem like at this moment that crypto is breaking hard along ideological lines. Trump certainly, you see him speaking at the Bitcoin conference, talks about making Bitcoin great again. Is that good for crypto or long term, do you think? Do you really need friends on both sides of the political aisle?
I think Bitcoin is digital capital, right? The world's going to be remade. There's a digital transformation in finance taking place. Everybody on Wall Street understands it. Everybody on Capitol Hill understands it. Everybody on Main Street understands it. It's like electricity or fire or the internet. I can't imagine that a nation state, a company, a government, or any particular family even is going to be successful without embracing technology.
I've got an investor psychology question for you, Michael, too. It just interests me. I'm curious how you kind of stay, calm and cool and collected and committed to Bitcoin, even when you have these sell-offs, because that's tough for some people, Michael. They see their investment get banged up, and then oftentimes the first instinct is, you get nervous. You want to slam the sell button. How do you navigate that? How do you actually keep your emotions in check?
Well, first of all, Bitcoin's been appreciating at 55% a year for the past 4 years. Bonds are depreciating 5% a year. The S&P is appreciating at about 13% a year. It's amazing to me that people would rather have a 20% ARR with 20 vol than 55 ARR with 55 vol. But if you think about it, it's pretty obvious you want the 50% return, not the 20% return. So if you're going to embrace the future, embrace digital transformation, it's going to be more volatile, it's going to be higher performance, but that's the future. So I don't get upset because I know we're winning, Bitcoin's winning. It's pretty obvious to anyone that can chart the thing that there's a right answer and there's a wrong answer.
Michael, safe to assume you bought the dip this week?
We're buying all the time. We're buying every quarter. We're buying the lows, the mids, the highs. I'll be buying the top forever because I'm expecting Bitcoin will continue to appreciate as digital capital. I think physical capital, real estate capital, financial capital, people are going to sell those things and they're going to move their money into digital capital, and it's going to be a trend for a long, long time to come.
A trend that you've certainly been at the helm of as the largest corporate holder of Bitcoin, Michael. Thank you so much for joining us. We do appreciate your time again. That was Michael Saylor. We're going to do a check-in now on some of today's top trending tickers again. And I'm going to kick it off with shares of Trade Desk. You're looking at gains of over 12% after the company topping estimates on both the top and bottom line, while its outlook also pleasing to Wall Street, clearly, if you're looking at that stock reaction. As a reminder, this is the ad tech company reporting these results that beat expectations. Interesting that Morgan Stanley in particular highlighting the company's ability to execute and, quote, consistently outperform. They also talked about the company's partnerships with Netflix and Fox, demonstrating their ability to kind of lead in the broader space. Even Jefferies highlighting not just Netflix, but also Roku as a partnership that has been material in terms of contributors to their earnings throughout 2024. Also mentioning that could be a catalyst for budgets shifting into programmatic CTV in 2025 moving forward. But I think just in terms of the story behind this stock, it's just interesting given the pressure that's been on this broader sector, seeing the performance that they've been able to pull out. And I guess the street is saying that that's partially due to these successful partnerships is interesting.
Yeah, Youssef Scully over at Truist, he's a smart guy. Youssef telling his clients the company's execution remains exceptional amid a volatile digital ad environment, talks about what he sees as a large and compelling TAM, total addressable market, says it remains one of his favorite names for 2024, which is not an unusual opinion. Most analysts on the street, nearly 80%, say this one still a buy.
All right.
Moving on, switching gears to Cisco System. That company reportedly planning to cut thousands of jobs in a second round of layoffs this year. So Cisco planning to eliminate, let's see, this is according to Reuters, by the way, thousands of jobs. Following Cisco's moves to cut about 4,000 jobs, remember, in February. The company does have about 85,000 jobs, at least that was at the end of fiscal 23, just to put some of these numbers in context. Yeah. This is, of course, not the only big tech name we've heard making these kind of cuts. Intel, Maddie, recently saying is going to be slashing about 15,000 jobs. And apparently the job cuts could be announced as early as Wednesday, which is when the company is scheduled to report earnings.
I think the use of the word thousands is so critical there, Josh, because we saw the stock sell-off really reversing in a relief rally driven by just a 7,000 miss when it came to the number of people applying for unemployment. Just 7,000 people didn't do it, and that is what led to the relief rally that we saw over the course of this week. Now we're hearing Cisco potentially laying off thousands of people. We don't know the exact number yet, but that is certainly going to potentially be a contributor to the jobless picture that is causing a lot of concern for the street. And also in the broader tech industry, I have a stat here showing that over 125,000 layoffs have occurred over nearly 400 companies this year just in the tech space. And of course, we know Intel, a huge contributor to that as well.
Yeah, Cisco, we know is the networking equipment giant. Under Chuck Robbins, they've expanded, much harder into software and services. The stock, not great, down about 10% now this year.
Well, another story that we are looking at here, Stellantis planning to cut jobs at a truck plant in Michigan. As many as 2,450 hourly positions are set to be eliminated. You can see the stock down nearly 1.5% at the moment. Now, we got a statement, our Pras Subramanian, who covers autos for us here at Yahoo Finance, got a statement from Stellantis in response. This is about the end of the production of the Ram 1500 Classic at that Warren Truck Assembly plant. They talked about the Ram 1500 being a great entry point pickup for the Ram and tradesman models as well, that they introduced it and have seen a change in sort of the demand picture moving forward. But this is leading to, of course, a change in strategy and direction for Stellantis that, of course, led them to this decision about layoffs. And again, autos is a key contributor to unemployment broadly across the country. We've certainly seen this in the geographic picture when it comes to Detroit. So I'm certainly going to be looking at that in the next jobs print. Josh.
Yeah, I was reading layoffs could start as soon as October 8th. I did read also, though, union members will be given the chance to work at other plants as well.
So that's very important to note because that could also impact the unemployment numbers we see out of this. All right, moving forward here, the S&P 500 eyeing a winning week as investors' recession fears looking to ease here. The U.S. economy not out of the woods yet as recession risks do linger. The Fed's path to rate cuts still a key piece of the economic puzzle. Here to discuss, we've got Greg Ip, Wall Street Journal chief economics commentator. Greg, it's great to have you on. Thank you so much for being here with us. So you had this piece this week, and in it you compared the SOM rule to weather forecasts. And as a reminder to our audience, a SOM rule is a recession indicator. We talk about it constantly. Tell us the comparison, because I loved it.
Sure. Okay. So the SOM rule basically says that when the unemployment rate has risen a certain amount over a year or so, you're always in a recession, at least according to the historical record. But the point I just want to make here is that's a correlation. It doesn't actually tell us that the rise in the unemployment rate causes a recession. It just means that historically, that's one of the things you see when you're in a recession. Just like normally when it's raining, you see a lot of umbrellas open. But honestly, if you really want to know if it's raining, go stand outside. And if you want to know in a recession, look at all the other indicators that tell us we're in a recession. And the mere point I'm trying to make is that if you look at things like payroll growth, industrial production, real incomes, those things have been growing for the last 3 to 6 months. So other than the rise in the unemployment rate, we don't have any strong evidence that tells us we're in a recession right now, or at least in June or July. For the month of August, clearly we have no data.
How important, Greg, is that data we're going to get next week? We do get some, CPI, retail sales.
Well, the retail sales numbers will be very important because consumption has been very strong. As you know, consumption is about 2/3 of economic activity. It was very strong through the month of June. Some of the preliminary credit card data, retail chain data tells us that July was a good month, but the official number will tell us if that continues. If that number weakens a lot, that might be the sort of thing that gives you a bit of a concern that negative feedback loop of falling spending, falling hiring, falling incomes, and then falling spending again might be getting started. The CPI, the inflation number, that's important for a different reason. If we see that the inflation number in July was actually very well tame and very subdued, that basically removes one of the last barriers to the Fed cutting interest rates as soon as September by a quarter or perhaps half a percentage point. The reason that matters is that if we're not in a recession now, keeping us out of recession is really up to the Federal Reserve moving quickly to lower the cost of borrowing.
Well, I'm curious about the interplay you see between the stock market and the Fed's moves. You mentioned in your piece as well that there have been some examples in this earnings cycle of weakness, like McDonald's, Intel, and Delta, but that the broader picture is looking good and it is on track to be another record-breaking quarter for earnings. Just broadly, how does the stock market inform your thinking of the economy? Is the market the economy?
Well, the stock market matters insofar as it's got a pretty flawless track record of predicting recessions, insofar as I think pretty much every recession was preceded by a big drop in the stock market. The problem, of course, is that not every big drop in the stock market was followed by a recession.
Right.
It does have, false alarms. And so trying to understand what we're going through, whether this is really just a market event or an economic event, it depends partly on the reasons that the market is falling. And as best I can tell, there was a little bit of fear over the unemployment numbers driving this market sell-off. But the biggest factor really was what happened in Japan. A week ago, the Bank of Japan raised interest rates and said more rates were in store. That kind of rattled people, and it basically forced a lot of investors who've been betting on low Japanese rates and a low yen to get out of those positions, and that caused a very abrupt sell-off in Japanese stocks, which then rippled across the ocean. Here we are about a week and change later. The S&P is only down around 5 or 6% from its all-time high. That's not a steep enough drop to normally tell us that we're in a lot of trouble. And again, you'd worry about the stock market if it was responding to bad news from the corporate side. Not something we're seeing yet. Earnings season, as you were just saying, looks pretty normal. The final reason you'd worry about the stock market is that, of course, stocks are part of household wealth, and people, when they lose their wealth, might be less likely to spend. And I think it's also an important input into the psychology of investors and businesses. If you own a company and you're thinking of expanding, maybe hiring some people, opening a new store, maybe you don't take that step if you're looking at the market saying, that looks like trouble. So there's a kind of a self-fulfilling prophecy aspect to a weak market. So it's very hard to know exactly what we're in right now. When I look at everything, the market behavior, the data we have so far, it doesn't look yet like we have a recession in the cards.
Greg, earlier this week we had on Alliance Chief Economic Advisor Mohamed El-Arian, and he was highlighting his concern on the Fed's policy decisions. Greg, take a listen.
On the policy side, I've been of the view that the Fed had waited too long. They should have cut, they didn't, and now they're perceived to play catch up.
All right, Greg, so you heard that. Mohamed thinks, Jay Powell waited too long. What's your response to that?
So the point he's driving at is, look, the Fed has two mandates, low inflation and full employment. And sometimes those two mandates are at odds with each other. Right now, inflation is above its 2% target. That says keep interest rates high. On the other hand, it kind of looks like unemployment is also rising. That says lower interest rates. So as you can see, their two mandates are pointing in opposite directions. That leaves them in a bit of a dilemma. If they'd never allowed the inflation cat out of the bag, then they wouldn't be in this dilemma, and they'd be able to focus purely on the employment side. That said, there's nothing simple in life. And when the Fed looks at the economic picture, it has to take a balanced approach. It cannot be purely focused on inflation or purely focused on unemployment. It has to balance the relative risks of those things. And the question they're asking themselves right now is, what are we worried about more? Cutting interest rates and getting stuck with a high inflation problem, or not cutting interest rates and getting stuck with a recession? Some of this will depend on the number we get next week for the July CPI, but my betting is that they believe that all else, taking everything into consideration, inflation is slowly but steadily moving back to that 2% level, and they don't have to worry about it so much, and so they can focus their attention on the unemployment picture, and that should give them the freedom they need to cut interest rates soon.
Greg, in our final minute with you, I'm curious how you viewed this week as a commentator, because it kind of felt like the market news that us nerds are obsessed with broke the fourth wall this week. I was getting texts in the family group chat constantly about whether or not they should be freaking out. What did you attribute that to? It just felt a little bit different to me.
Well, I'm going to reveal a little bit about my age here. The very first market downturn I covered was in 1987. I was in college. Stock market crashed that week, and I still remember the predictions that we'd have a recession as a result. And of course, we did not have a recession. And it was an early lesson that you need to pay attention to what's going on in the markets, but you need to essentially merge that with a big, aggregate suite of information, including what's going on with the economic data, what you're hearing on the policy front, and so on and so forth. And so I've learned the hard way there's no simple answer. You can't simply look at the data or look at the markets to decide what's happening, and that there are no foregone conclusions. And when I look at that, I sort of look at the market behavior and I say, hey, it's been a heck of a run. We haven't even had a 10% correction yet. Don't be greedy. Don't think that just because the market sells off a bit, the world is coming to an end. Stepping back a little bit, if the market was telling us a recession was in the cards, we'd see other signals of it. We don't see those signals yet. We do see some stuff going in a troubling direction. That's what the Federal Reserve needs to stay on top of. And as best as I can tell, they have the time and they have the means to respond quickly and prevent that recession. But, you know, there's a certain animal spirits psychological element to this that is entirely unpredictable.
Very true, Greg. All right, thank you so much for joining us. We appreciate it.
Thanks for having me.
Coming up here, shares of Zillow on the move to the upside today following an executive shakeup earlier this week. We're going to speak with the new CEO, Jeremy Waxman, on the other side as he steps into this new role at Zillow. Stay tuned, more market domination to come.
Shares of Zillow having a pretty good run this week after reporting second quarter earnings. A welcome sight as the company is having a tough year in a sluggish housing market. Zillow also announcing new CEO on the earnings call. That would be Jeremy Waxman, and he's joining us right now. Jeremy, it is good to see you and have you on the show. Listen, it's the first time we've gotten to check in since you did report those earnings. So let's start there, Jeremy. Just talk to us about that report. What are you seeing in the business?
Yeah, we reported earnings this week. Q2 was really strong, ahead of guidance on all measures. Revenue up 13% year over year, and a lot of that flowed through the bottom line for an EBITDA beat as well. And that revenue growth was really across the business. Our residential revenue was up 8%, our mortgages revenue was up, and our rentals revenue, which is now 20% of our business, also growing sharply, up 29% year over year. So, despite a still challenged housing market, Zillow is outgrowing that market. This is now 8 consecutive quarters of outperformance, double-digit revenue growth in Q2, and we're guiding to do that again in Q3 with 10 to 13% revenue growth as our target.
And Jeremy, in terms of looking under the hood here, it is still another unprofitable quarter for the company. What do you think is going to be the catalyst to turn that around?
Yeah, so we are investing pretty healthily in our housing super app strategy. We've been doing that for a few years now. You're starting to see the results of those investments pay off, right? That's what's driving the outperformance across the business. And that's what's driving what's really our midterm target, which is to grow our share of transactions in the market. Despite having this huge audience, right? Hundreds of millions of people come to Zillow every month to dream and to shop. We only help a small fraction of them actually buy, finance, or sell their home. And that's really our goal, to build the products and services to help more of those folks move, to help those folks tour homes, to help those folks finance those homes, and to work with our great agent partners to move. So those are the investments we've been making. That's what's driving our revenue growth. That's what's driving our EBITDA outperformance. And of course, our mid and long-term goal of net income GAAP profitability is one of our targets.
And Jeremy, just to broaden it out a bit too, I am curious to get your take on just the overall health of the housing market, Jeremy, where it is and where you see it headed.
Yeah, the housing market is challenged. It's low volumes and pretty high price increases. And what that means is really tough affordability for buyers, especially first-time home buyers. You put those two things with the high interest rates we have, and it just makes it tough for a home buyer. So that's why you're seeing such low volume, right? Despite all that, we're able to grow our share, and we're able to help more folks start that process when it works for them. But for sure, the last few years, you've seen really low transaction volumes while prices have increased.
Jeremy, I'm curious about what you saw in terms of activity over the course of this week when we saw mortgages dipping to a 15-month low. Do you see that driving more activity on your platform?
You know, it's interesting. Usually rate shocks and rate movements is what drives a pullback in activity, kind of in either direction. But I would say we've had so many of those in the last couple of years that buyers and sellers have kind of found this as the new normal. And the demand we have in the marketplace generally, we have a lot of pent-up demand from sellers who are stuck in their homes and stuck in, locked in on a rate that they don't want to move out from. And then we have that high rate really squeezing buyers and squeezing their affordability. So the demand coil has really been loaded on both sides. And so any movement you see in rates will help over time. But right now, we have a lot of folks waiting, I think, for that relief.
And Jeremy, I want to just loop back on rentals for a minute, because I think you said there it represents about 20% of total revenue at this point. What are the trends you're seeing? What are you seeing the trends there, Jeremy?
Yeah, so many folks may not know, but we're actually the largest rentals marketplace in the country. We have the most listings, so there is no national database of all listings out there. It's really tough for a renter. You have to shop around, and we've been trying to amass and build as much of the listing inventory as possible. We now have the most inventory, which has yielded the largest site for renters to come. So renters come to Zillow and they look for listings, and in many cases, they can actually book that listing on Zillow. They can apply for it, they can sign a lease, and they can even make payments to their landlord on the platform. And that's driven the growth we've seen in our marketplace. So our rentals revenue is up 29% year over year. As I said, it's now about a fifth of our revenue and continues to grow really nicely. And what's really driving that growth is the multifamily segment. Our multifamily advertisers, the big buildings we all see downtown, they are really excited and leaning into the demand, the renters coming onto our platform to try and find more renters to fill their buildings.
Jeremy, let's talk about the fact that you've got a new job. The co-founder, Rich Barton, stepping down as chief executive. You are coming into the top executive position. You've obviously been at the company for a while. Talk to me about why now for that shakeup.
Yeah, I mean, the answer to why now is really how well the business is going. Right, I've been here for 15 years. I've worn many hats. I spent a lot of time in product and marketing, as well as leading a bunch of our business and operations. And obviously, Rich and Lloyd Frank, our co-founders, have been here the whole time, and they aren't going anywhere. They're still going to stay as executive co-chairman and help with strategy and help really support me and the leadership team. But why now is the business is doing so well. The quarter that we just reported, the guidance for the growth we have ahead shows that our strategy is working. This idea that we want to move from an advertising business to a transaction business, that we want to take this huge amount of potential energy in our audience and help more of them actually turn into transactions and build the software and services to help them do that. That's what we've been investing in for the last few years, and you're starting to see the results of that pay off. We have a lot of confidence in the road ahead and the ability for us to grow that share over time. So that's why we feel so comfortable making this transition now.
All right, Jeremy, thanks so much for joining us. We do really appreciate it. That was Jeremy Waxman, the latest CEO of Zillow.
Thanks for having me.
Let's get to our calls of the day. TikTok and Pinterest will reportedly enable buying from Amazon in their apps. Bank of America Securities publishing a new note on the news, maintaining its buy rating on Amazon. And Josh, what fascinated me about this note is that I was on the Amazon call this quarter and the last quarter, and both times executives were receiving a slew of questions about competition from Shein and Temu specifically, and trying to figure out when Amazon was going to release more information about partnerships with those retailers that are certainly fast fashion, but also very affordable for consumers. And so that's very much so a headwind for Amazon. And then on top of it, you layer on TikTok Shop, which has not only the competitive factor of products, but also the sellers who are flocking from Amazon to TikTok Shop because they're making a heck of a lot more revenue by selling products on TikTok. And so it's interesting to see what this could look like moving forward, and if it is going to be the next big upside move for Amazon in terms of its e-commerce business, because there is such a strong demand from the consumer for these more affordable brands.
Yeah, a team at Bank of America weighed in. They seem to like these deals. They said if the deal improves ROIs by 20%, estimate an opportunity for an additional $1 billion out of GMV. They said it could aid sentiment on concerns around TikTok Shop competition. Obviously, Bank of America is a buy on the name. Amazon could use some love. I mean, year to date, the stock is up about 10%, but it's down about 15% from its record close. And the company, of course, did recently report earnings results and projected that weaker than expected revenue growth, and investors were obviously disappointed.
Yeah, and that certainly weighed on the stock following that earnings print, as you mentioned, Josh. Well, another stock that we are looking at, Morgan Stanley naming Eli Lilly a top pick in a note today. The note saying that the drug maker has the, quote, strongest growth profile within its coverage universe. And this was really interesting, this top pick, because they're talking about a couple of things here when it comes to Eli Lilly's performance, right? One of them is this idea that Eli Lilly has been talking about and spoke about on the call, the idea that their shortages of the drugs, the weight loss drugs that they're offering are going to start alleviating soon. That is a potential upside catalyst for the stock moving forward. They also said that they believe that Lilly offers the most attractive opportunity in coverage for upside to consensus estimates despite the stock's outperformance. So they continue to see that upside movement moving forward here. And also just that the drug maker has kind of come from behind here. Novo Nordisk was the first to get to market with a weight loss drug back in 2021. And then Eli Lilly came onto the scene with their own competing drug. And to me, it's kind of an interesting story about how you don't necessarily have to be first to win. That becoming even more clear with this Morgan Stanley pick.
Yeah, Morgan Stanley saying Eli Lilly has the most robust new product cycle and hence growth outlook in pharma. Says the company could launch 5 new drugs over the next 2 years, reiterate the overweight. They take their target up to 1106. This stock has enjoyed obviously a very strong run. It's up more than 50% already this year, but clearly Morgan Stanley says, you know what? Better times ahead.
Yeah.
All right, coming up, Walmart will look to shrug off that slowing consumer trend when it announces Q2 earnings next week. We're going to preview what to expect from the retail giant right on the other side. While other companies have pointed to the consumer not spending as much in recent earnings calls, Walmart will look to shrug off that trend when it announces Q2 earnings next week. And our next guest thinks the retailer will be a standout. Joining us now is Michael Lasser, UBS US Hardline and Broadline and Food Retail Analyst. Michael, it's good to see you. So Walmart earnings on deck next week. You know, heading into this print, Michael, nice run for the stock. It's up about 30% already this year. What are you expecting to hear?
What we're expecting to hear is, the consumer overall has been consistent, which keep in mind that Walmart sells mostly groceries and other household products. And it's taking market share. So what it has been experiencing is going to be a bit different than what other retailers have been experiencing. We also expect to hear that all of the alternative profits remain growing very rapidly. Areas like advertising, third-party marketplace fees, membership fees, logistics services, and data monetization. That is a key element of the story. It's one reason why Walmart stock has appreciated so handsomely as of late. We also expect that the company is going to raise its guidance. Last quarter, it said that it expects to be at the high end or higher of its full year EPS guidance, and we think it will take this as an opportunity to raise its full year EPS guidance. So all of this means that the bull case on Walmart is well intact and is likely to support the stock from here.
Hey, Michael, when I take a look at the performance of different sectors within the S&P over the last month, I'm looking at retail specifically down nearly 17%. It's one of the biggest laggards in the S&P. That to me indicates a little bit of the struggling consumer story that you had addressed in your first answer here. But I'm just curious, what exactly makes Walmart different? When we've heard from the likes of others in the space, even like a McDonald's, saying that their consumer is struggling, why would Walmart's consumer not be struggling?
So Walmart, the consumer is experiencing some challenges without a doubt. But Walmart is benefiting from those challenges because it has the perception that it offers amongst the best value in retail. The other thing that's happened is it's become very expensive to eat out. So there's a shift away from food away from home to food at home. And given that Walmart sells 1 out of every 5 grocery dollars in the United States, and is the largest single player in the grocery market, it's been benefiting from that trend. So those are a couple of the reasons that make Walmart a bit different. With your point is very fair that it has been challenging, to say the least, for the retail sector so far this year. We expect that that's going to continue through at least the end of this year, not only because of consumer trends that are very episodic, but also in response to that, consumers are becoming more promotional and aggressive, which poses the risk that that's going to pressure their margins. So all of this is resulting in stocks that you need to be very selective amongst when approaching investing in the retail sector at this point.
What about Home Depot, Michael? Another name we're watching closely. Reports next week, next Tuesday. Your expectations there?
My expectation is that Home Depot's sales trends were going to be a little bit softer than what was embedded in the consensus forecast for the second quarter. And as a result, the company is most likely going to take a more conservative stance on the outlook for the back half of the year. Keep in mind what's happening on within the home improvement sector is people are just simply not moving. Normal existing home sales in the United States are somewhere in the range of 5.5 million. The most recent indication it has been that only 3.8 to 3.9 existing home sales took place in the United States. Those lack of move events meant that there's just fewer flooring projects, projects that involve cabinet, those things that are typically done when someone's moving into or out of a home. In addition, we've all heard about this noise that interest rates are going to come down. So if you're a consumer and you're thinking about financing a big ticket remodel, you're inclined to wait at this point until the financing of that project is going to become a little bit less expensive. All of that means the conditions are set for an upturn. That's probably going to occur in 2025, and we'll hear that from Home Depot when it reports next week.
Certainly, Michael, and it's a big week for earnings, both for the retail sector, but also for the retail sector in terms of those sales numbers we're going to be getting next week. So we'll definitely be giving you a call to chat with us more.
Thank you.
Thanks, Michael.
Have a great weekend.
You too. Thank you so much. Well, while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including a conversation with Sweetgreen co-founder and CEO Jonathan Neiman on the back of their earnings print. Stay tuned. More market domination overtime next. And that is the closing bell on Wall Street. Now it is market domination overtime, and I'm just going to do a quick check of the markets here. You're looking at gains in the S&P and the Nasdaq. I just want to see if I can take a look at what we're seeing from the S&P 500 over the course of the last 5 days. You can see today that it closed up nearly 0.5%, but it's interesting to see the S&P essentially reversing the volatility that we saw over the course of the last 5 days. I also quickly want to point out the VIX closing below that key 21 level. That again also brings the VIX below where it began at the start of this volatile week that we were all freaking out about, and now it looks like much ado about nothing if you take a look at the market after the close today. But Jared, let's get to you for a closer look at the sector action and what that tells us about how the volatility has sort of wrapped up today.
You bet. VIX at a 20 handle. Nobody would have expected that Monday. Here's the sector action for today. Communication services, that's XLC, and XLRE, that's real estate, were the only outperformers over the S&P 500 here. Materials down 10 basis points, really a ho-hum day, and I think a welcome respite from the volatility that we've seen this week. Here is the sector action for the entire week, and what's amazing is that these numbers are so small. Industrials up 1.3%. Energy up 1.1%. Worst losses, materials 1.7%, consumer discretionary 1%. These are sectors that had huge swings this week. Here's a 5-day of the tech. In the tech sector, you can see just climbing into the green today, but it had been significantly underwater as of Monday. So really a successful week for the bulls in that it wasn't worse. So here's our leaders of the day. We got the week, actually. We got momentum, IPOs, software did well, Chinese stocks, semiconductors, transportation, and defense, which did not do well. That would be the home builders, Bitcoin, Korean stocks, and solar. Just taking a look at the Nasdaq 100 for the week, a lot of carnage in the mega caps. Well, I'm not going to call that carnage. I'm going to say we saw some downside action because this is not carnage. Meta's up 6.1%, Broadcom up 3%, Tesla is the worst off of the megas, doing about 3.7%. Again, all in all, could have been worse this week.
Could have been worse. That is certainly true, Jared, when you're looking at where we stand after such a volatile whipsawing week. Jared Blickery, thanks so much for joining us. Moving on here, Sweetgreen having a sweet Friday. That stock up over 33% on the back of its second quarter earnings, which saw the salad chain post sales that outpaced market expectations, raising its outlook for the full year as well. Joining us now to discuss, we've got Jonathan Neiman, Sweetgreen co-founder and CEO. I'm also joined by Yahoo Finance's Brooke DePalma. Thank you so much for joining us, Jonathan. So listen, that stock price, you got to be happy with that over today, up over 33%. But people who bought at the IPO, as you know, they've been underwater for a while. So I got to ask you about the profitability piece because the company is still not profitable. When do you expect to see a turn in that?
So we're very focused on driving profitability, and I'm very proud of the results of this quarter. So first, I want to just take a moment and thank the team for all of the hard work, all 7,000 team members that brought this to life. And if you look at this quarter, there's a few standouts. One, sales grew 21% with a 9% comp store sales. Our restaurant level margin increased to 22.5%, and we had great controls over our G&A, leading to an adjusted EBITDA of about $12.5 million. So from an adjusted EBITDA perspective, we are profitable. We are working on driving it from a net income perspective and feel really good about our path to profitability as we continue to open more profitable stores and continue to leverage our cost structure.
Jonathan, last week Sweetgreen turned 17 years old. Kudos to you guys. I can't imagine.
Almost going to college.
Almost going to college, certainly. I can't imagine that the price is still the same. I know that a bowl now is roughly $15, but you did see those same store sales comps up 9% year over year. Do you think Sweetgreen still has pricing power here?
Absolutely. I think we do. I think we're going to be very judicious in how we use it. We want to make sure Sweetgreen is the type of thing that people should enjoy in a habitual way. And so we're very judicious about it. I think one of the benefits we're seeing right now is we've taken less price than our competition over the past 4 years. So as you look at the relative pricing difference between Sweetgreen, some of our fast casual competitors, and then QSR, the gap has really narrowed. I mean, QSR, you can't get in and out of there for under $15 today. And so I think consumers are seeing, as more and more people wake up and realize they want to eat real food that is good for them, good for the environment, but still fresh and craveable and convenient, Sweetgreen fits that perfectly. And I think in a lot of ways, our value proposition is only improving.
Infinite Kitchen is something that has lots of investors buzzing. That's, the robotic futuristic restaurant design you guys have. What sort of overall cost savings does this model present, especially in an environment where we're still seeing low single-digit labor inflation?
Yeah, so we're very excited about the Infinite Kitchen. It's something we've been working on for many years. And the idea with the Infinite Kitchen was, how do we really make a true win-win-win? Make a better experience for our customers, which we are doing. You can now get a Sweetgreen meal in about 3.5 minutes, which is just phenomenal, perfectly portioned, and the food quality is even better. From a team member perspective, it's more enjoyable to work in the store, a little bit less stressful. They have this co-pilot to help them. And we're seeing about 45% reduction in turnover in those pilot stores. So really encouraging from a team member perspective. And from a financial perspective, what we've said is we expect about 7 or 8 points of margin leverage with the Infinite Kitchen. We've had a really good pilot. We're seeing almost 10 points of leverage from a restaurant level margin perspective. And so it is a true win-win-win. And we think over time, it'll give us a lot of strategic opportunities in terms of expanding our white space and going into more places. We do think labor is going to continue to go up and up. It is going to continue to compound, and we think this will be a very strategic asset for both the experience and for the financials of the company.
Yeah, Jonathan, you just mentioned the potential margin improvements that can be attributed back to Infinite Kitchens. How much of that do you anticipate coming from a decrease in labor?
Yeah, so a lot of it comes from being able to utilize less labor. And what we've done is we're able to use our teams for different things. So they get to focus on the hospitality piece of the business and the culinary piece of the business. So I want to be clear, in these restaurants, there's still a lot of team members. It's just that one part of that work is taken away. So you're seeing a lot of the leverage from labor. We are seeing some in terms of just being able to, manage our food costs a little bit tighter, but it is mostly from a labor.
Jonathan, what amount of team member dilution do you anticipate in each store? If you have a certain amount of team members in a store now, how many do you anticipate being in the Infinite Kitchen stores as a comparison point?
It really depends on the volume of the store and at what time, but typically we're the entire team on staff is about a third of the number of employees needed. And these, again, they're more enjoyable jobs for them. In the stores, we're mostly opening them in new stores. In the chances that we do a retrofit, nobody has lost a job. We're able to move employees to other locations if needed and make sure we find them their hours. So it's very important for us to take care of our team members as well.
Jonathan, menu innovation was a huge growth driver this past quarter. Now investors are really honed in on the potential of wraps, drinks, and desserts. What sort of capacity do you have left in the kitchen to include these new options? And will we see more robots going forward in the kitchen as well?
Yeah, so you're absolutely right. What's driven the growth this past quarter and really the past year has been a lot of the menu innovation. So shout out to Chef Chad and our culinary team and our marketing team for an amazing, amazing job. And so with plates launched last year, we started to see a big shift in dinner and weekends, a broadening of our consumer. Caramelized garlic steak continued to build on that. It's really helped unlock a lot of white space. And really, one of the things we mentioned in the call yesterday is we've seen a 3-point shift from lunch to dinner. We've also broadened the consumer. We're seeing more men. So very exciting of where that's gone and a lot of opportunity for where we go. So things like a handheld option, but more of a house-made beverage, a treat option are all things that we're testing and piloting and expand to be rolling out in the next year or so. And so we have a ton of capacity very intentionally when we built Sweetgreen. We built it as the restaurants with some modularity to be able to take on other types of food and formats. And so we're very excited about kind of broadening the occasion for Sweetgreen, broadening the menu and bringing more guests inside the brand.
Jonathan, thanks so much for joining us, and thanks for coming to Yahoo Finance to talk about that earnings print. Have a great weekend, and also huge thanks to our very own Brooke DePalma for bringing us the conversation as well.
Thank you for having me.
Stick around. We're going to have more market domination overtime coming up here.
The narrative remaining consistent in the last few weeks for inflation, gradual improvement while still elevated. Yet the inflation focus among voters when it comes to the presidential race seems to be changing course. Yahoo Finance's Rick Newman joins us now with more. Rick.
Hey guys, so obviously I've been following what's been happening with Kamala Harris's now presidential campaign. She is shooting up in the polls, and her approval rating has risen by about 10 percentage points based on which poll you look at within the last 6 weeks or so. Obviously, people are learning a lot more about her. And, my economic brain sort of short-circuited at this because I've gotten used to the idea if you're an incumbent in the Biden administration, you have to explain away inflation. And until inflation basically goes to zero or, the price of hamburger falls by 50% or something like that, voters are just going to hate you. And that is not happening to Kamala Harris. It appears that she's getting a pass on inflation, which of course has been President Biden's biggest economic problem. His approval rating went down as inflation went up in 22 and 23, and it has never recovered. His approval rating has never come back, even though inflation has gotten a lot better. And of course, we've talked and written about this many times. Many consumers say, yeah, we hear you saying that the rate of inflation is down, but price levels are still high. All those price increases that happened over the last couple of years, those are still there, and we're just paying more for stuff. It appears, this could change, but it appears that Kamala Harris is getting a break on inflation. Voters don't really hold her responsible for inflation, and I think that's a really important point if it turns out to be true in the election going forward, because it just gives her a lot of room to get more support from voters on economic issues, which of course are some of the most important issues. If they're not blaming her for inflation, they might be more inclined to say, well, I want to listen to what she has to say. What are her policies? How is she going to make my life better during the next 4 years? And many voters just seem to have closed their eyes and ears to Biden. So the fresh start for the Democrats really seems to be working.
Well, Rick, I've got to bring something up to you that my colleague here, Josh, was the one to find. So huge hat tip over to Josh here. But Josh was looking on the Harris Walter website and found that there are many buttons to click on donation options, but there's not a list of policies yet. And I know this is something the Harris campaign has received a lot of critical pushback on, particularly given the fact that she hasn't had a media interview. Rick, what do you make of the lack of policy positioning?
Just send us money. We'll tell you what we stand for later. Sure, why not? I mean, this is starting to get a lot of attention. The Harris campaign, and by the way, Donald Trump in his no news conference yesterday, he picked up on this theme. What I think they're doing is I think they are just riding the rocket ship as far as it will take them. And it is taking them pretty far so far. I mean, without any policies that are distinct from Joe Biden's, she is now ahead of Donald Trump in the betting markets when bettors try to guess who do they think is going to win the election. It is now Kamala Harris by a couple of percentage points over Donald Trump. I mean, that is a remarkable turnaround because Trump was up by something like 65% or even 70% just a month ago. So I think if you're the Harris campaign, you're looking at all these numbers and saying, this is working for now. Let's just keep doing what we're doing. But it's not going to keep working forever. I mean, by the end of August, the honeymoon part is probably going to be over. They're going to get a little convention bump. Then it's going to get ugly in September and October. I think this is not that hard for Kamala Harris because on most things, she's basically just going to say, I stand with Joe. Joe Biden's policies are basically my policies. What we'll all be paying attention to is where does she really distinguish herself from Joe Biden? We have a few guesses that they're not earthquakes. It's not like she's vastly different on tax policy or something like that. But I think there's going to be plenty of time to get into that.
There'll be an interview and a press conference at some point, Rick. I don't know when. We got 90 days. We'll wait for it. Thank you, Rick. Have a great weekend.
Bye, guys. A lot more to talk about.
Tech stocks outperforming the broader market today, capping a wild week on Wall Street, but the Nasdaq did extend its losing streak to 4 straight. Joining us now is Nancy Tengler, Tengler Investment CEO and Chief Investment Officer. Nancy, it's good to see you. It was interesting, Nancy, because we went into the weekend here relative sense of calm, and I feel like we kind of earned it. It was a wild week. It was Monday. It was red across the screen, Nancy. You heard it, the growth scare. Got people calling for emergency cut, and now relative calm. What did you make of the week, Nancy? You must have been fielding phone calls from your clients. What were you telling them?
Well, what I'm going to tell you, Justin, thanks so much for having me back, that this is a long-term secular tailwind behind technology. And, you know, it sort of started when Alphabet reported earnings and said their CapEx budget was going to go up. But remember that one company's CapEx budget is another company's revenue growth. So it matters where you're positioned in this market, but I thought this was a great opportunity to add to some high quality names. And in addition, we get a correction one way or another about every 12 months. And so this is long overdue. I'm not sure it's over, by the way, but this was long overdue. And so I think what we'll see is that the good companies will continue. They'll you know, sort of consolidate, and then we'll continue to see some movement up because generative AI permeates the entire economy.
Well, Nancy, I can't wait to ask you about this because you have some bullish statements about the AI space, but then you didn't buy the NVIDIA dip this week, which I'm fascinated by. How are you stomaching holding off on getting into NVIDIA?
I saw a quote in the Wall Street Journal. Some guy equated it to having a root canal without a Novocaine. I actually had a root canal without a Novocaine when I was a kid, and it's nothing close to that. Eventually, you just pass out. But yeah, I think two things: the resistance for NVIDIA is at 97. We're not going to get too cute, but we are adding another chip name today and on Monday, so I can't talk about it yet. But another beneficiary.
Oh, come on,
the,
Nancy! You can give us
AI.
Can't you give us a hint, Nancy?
It's not Intel, and it starts with A.
No, okay, not Intel. All right.
No, we exited Intel years ago, and gosh, couldn't be happier. But so I think you still want to be exposed to these names. The infrastructure spend will continue. These are unlike in the 90s where the underlying customer was unreliable and the four horsemen fell. These are reliable clients with robust earnings growth and pristine balance sheets. So take a breath, look around, and see what you want to own.
What about Broadcom, Nancy? I know you've come on here before. You pounded the table for Hock Tan's company. Smart, and listen, you got company. There's some smart analysts on the street. I think of guys like Stacy Rasgon. They think it's a really smart AI play. You still like Broadcom here?
We do. You know, Josh, we bought it when the Computer Associates deal was announced. And remember, if it wasn't Wall Street's idea, it wasn't a good idea. So the stock sold off. I think it was 2018. And we've owned it ever since. We had been trimming our tech holdings on July 11th pretty materially. And now we're going to go back in and add to some of the names that got beat up. Broadcom's at the top of our list. It's our largest holding across all of our strategies. It's in our ETF, TGLR, and it's in our 12 best ideas portfolio.
Nancy, I'm interested in this stat I'm looking at right now. In the S&P 500, Mag 7 is having solid profit recovery throughout the earnings cycle. Mag 7 is not really holding on to its role as the driver of the ship for market earnings and profit growth in the S&P throughout this earnings season. Is that indicative of a sickness within the market, given that we have relied on the Mag 7 so heavily, or is it a healthy turn?
No, I most definitely think it's a healthy turn, and you've seen that the majority of the stocks in the S&P are actually near 52-week highs. So the broadening out is good, but we're doing it, and we have been broadening out in names that are old economy companies that have pivoted to the new technologies, and then the suppliers are the picks and shovels. So think of a name like Quanta Services, where they're going to be building the electrical utility plants, the electric utility plants that will be powering generative AI, and also, you know, a company that is supplying to the data centers, and that would be Carrier. And so those are the kinds of names that we're adding to. All have had good earnings. They've raised, beat and raised in many cases. So we think the story is intact. Yes, the economy is slowing. I don't think we're going into a recession. But if it's slowing, again, these are the kind of companies you want to own that are generating reliable earnings growth.
Nancy, I'll get you out of here with this. It's August, Nancy. You know, we got a few weeks, though. I'm just curious what you think some potential catalysts for the market could be? What's on your radar? Got CPI, retail sales next week. We got Jackson Hole, NVIDIA at the end of the month. What are you watching, Nancy?
We're going to be watching NVIDIA's earnings, of course. I think I said this the last time I was on your show. I've kind of stopped listening to the Fed. We know there's going to be a cut. It may be like the 90s because we have such high productivity numbers. And remember, that was the bright spot last week, that productivity came in much stronger than expected and was revised up for the previous quarter. That was the case in the 90s. Chairman Greenspan understood that. And so he only cut 3 times after a rapid increase in the Fed funds rate. And the Fed funds rate only got down to like 5.25. So you can have higher interest rates coexist with robust stock returns as long as you have productivity. And unit labor costs came down as well this last quarter. So we're pretty optimistic that our thesis holds steady, that productivity is going to drive earnings and economic growth.
Nancy, always love having you on the show. Thanks for joining us.
Thanks, Josh.
Time now for what to watch next week. Starting off on the economy, a few critical pieces of economic data out next week, including CPI numbers for July on Wednesday. That's the Consumer Price Index. Economists forecasting both core CPI and overall CPI to tick up to 0.2%. This coming against the backdrop of the Federal Reserve under a microscope, with investors looking for any new signs about the future of rate cuts heading into September's interest rate decision.
And moving over to earnings, we're going to be getting some more corporate earning reports from the likes of Walmart, Cisco, Home Depot, and several others. Walmart announcing second quarter results before the bell on Thursday. Analysts are expecting top-line growth in the second quarter, and the company's investments in lower prices are expected to resonate with value-seeking consumers as well.
And speaking of the consumer, U.S. retail sales numbers for July coming out on Thursday. That number expected to rise to 0.4%, giving us more insight into the resiliency of consumer spending.
Well, that's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The whipsaw week that was. Stocks ended today in the green. All three major averages were slightly negative on the week, but recovered significantly from Monday's steep sell-off. The S&P 500 saw its best and worst day in more than a year during that 5-day stretch. Plus, the state of streaming, both Paramount and Disney reported profits in their respective streaming units for the first time this week, but that hasn't translated into record gains for the stocks. We'll take a closer look at the biggest names in the streaming space next. And defense tech company Anduril Industries secures $1.5 billion in its latest funding round. It's the latest in a string of startups that have benefited from a surge in investments flowing into defense tech this year. We're going to discuss the sector's state of funding later on in the hour. Investors hearing from a slew of media names this past week. Both Disney and Paramount reported profits out of their streaming businesses for the first time ever. Join me now with more on the state of the industry is Matthew Dolgan, Morningstar Senior Equity Analyst. Matthew, it is good to see you. So feels like a good time to take a breath here, Matt. You know, we got a lot of reports from some streaming services. Disney and Warner Brothers Discovery and Paramount. You know those names, Matt. You know the sector. You read through the reports. You listened to the conference calls. What were your big takeaways, Matt? Where are we in the great streaming wars?
Well, all these companies other than Netflix are continuing to make progress, but they are just not there, not mature. The difference with them and Netflix a decade or less ago is that they have these other legacy businesses that they're managing. And so they're not getting the pass from Wall Street as streaming continues to grow and is not yet a mature or good business necessarily. They're seeing their other business decline. So they need that to turn. But with that said, we're pretty optimistic generally about how things have been going in the streaming space. Certainly, as you mentioned, losses have come down quite a bit and are turning to profit, in some cases in a way that we think will be sustainable from here forward, like we've seen a turning point. And they continue to generally add subscribers, grow revenue per subscriber. They're making it a better business, but it takes time. And in the meantime, their other businesses continue to struggle. And that's why the stocks, we think, are remaining under significant pressure.
And so they are getting, they're getting into the black. They're getting into profitability, Matt. Just interested to get your take, because I've heard some analysts throw, I guess you would say, cold water on that, because they say, well, they're getting into profitability here, but they're doing it because they're through raising prices and cost cutting. It's not through investing and creating and delivering really the kind of great content you need. What's your response to that sort of skeptical take?
I think it goes back to these being broader businesses. And so they do have, in each of these cases, the firms you mentioned, they have studios. They are continuing to put out content. Yes, they've cut costs in some places, but we don't think that they're producing too little content right now. We think that they need to figure out the best way for distribution. And to us, the thing that needs to get figured out or needs to evolve more is just looking at these businesses as a whole, rather than these separate segments where you have the traditional television or film, the linear business in television, certainly with streaming. And as they can both reach consumers as one, and as the businesses are looked at as one, we don't think that it'll look as severe as far as whether costs are coming down, because the content budgets at most of these firms have remained pretty high, actually.
Let me ask you, Matt, I got a 5-year-old at home. I'll be honest, all she watches is YouTube, constant YouTube. How much of a competitive threat does that pose to some of the companies, the streamers in your coverage universe?
Well, YouTube, along with Netflix, is by far the most watched streaming service. So it is a competitor for share of time, but that doesn't mean that that we see it as a really big threat, because generally it's different types of content. And so certainly, and especially the younger generations gravitate more towards YouTube. We still see it as a different type of viewing experience, and something that fits within broader media.
Final question, Matt. Another name I know you know very well, Warner Brothers Discovery, got their print. What is the future of that company, Matt? Do you think, is a possible breakup coming?
We do think that's possible, mostly because the company and the stock has struggled so badly. So although we don't necessarily think it's necessary, we certainly think that it could generate interest because of what it has been going through. But we think the bigger thing is that whether it is outside interest with an activist coming in or the company splitting up, we think that it needs to at least partner in the form of bundles or otherwise with some of the other companies to help drive its business forward and help it make that transition a little bit better.
Matt, great to have you on the show today, recapping a lot of these prints. Appreciate it.
Thanks.
The S&P 500 Nasdaq capping a major comeback on Wall Street, nearly wiping out the week's losses in a wild turnaround. Yahoo Finance's very own Jared Blickery joins me now with more on the trading day takeaways. Jared.
Thank you, Josh. What a week. And guess what? Investors still love tech. B of A crunched the numbers, and tech has now seen inflows for 6 straight weeks. So this week's, notwithstanding the volatility that we saw, didn't really affect the market, at least the tech trade and the flows that we're talking about that much. Had a lot of effects on the markets, though. This is the semiconductor space over the last 5 days. Lots of green. NVIDIA's red. But what impresses me is that we were able to eke out some gains here and even some outside gains in a lot of these names. Intel down 8%, Supermicro 18%. So there were some big losses, but a lot of the losses are just earnings stories or not really wrapped up in the volatility and the trade that went on. Here's software. You're going to see probably more green than red if we go to the equal weight. So my point is, I mean, you look at the sector action. I was noting this 30 minutes ago. There are no big numbers here. 1.6% to the downside of materials. Industrials up 1.3%. These are small numbers.
So you're watching the flows. Any other trends we should be watching? Bonds overseas?
So let me show you what Michael Hartnett's team over at B of A showed or found this week in flows. High yield bonds, we're seeing a lot of outflows, most since October 23. So the credit risk, now that's a different type of risk in the bond market. Investors don't want that. They're not liking bank loans, so that's another credit risk. TIPS seeing the largest inflows since April 22. That tells me that investors are worried about inflation. Why would that be? The Fed is going to cut rates maybe by 50 basis points. So that's where that comes from. Nobody likes European stocks. Nothing new there. Financials, biggest outflows since November 23. Could have some things to do with the yield curve going on right there. And then tech, 6 weeks of inflows. That's kind of back where we started. So that about caps the weeks in flows here.
All right, give me Jared Blickery. Point number 2.
You bet. Bonds. Bond yields are bouncing back. Yeah. And so let's take a look at the yield curve here. I have a handy dandy. Purple is where we are now. The pink is where we were a week ago. And you can see we're a bit higher here. Now, this may seem strange. Why are bond yields higher when we're talking about the Fed lowering rates? That's because they were coming from depressed levels last week. So let me just show you what happened with the 10-year T-note yield over the last few weeks. And in fact, I'll just bring up a chart of the year-to-date price action in the 10-year. Hard to see that, so let me put the line on. There you go. So this is what happened this week, but this big drop, that's what happened last week. And let's not forget that the BOJ, the Bank of Japan, it was last week that they raised interest rates over in Japan. So I think that dynamic explains that.
And when you're watching the bond market,
yes,
all right, Jared, what are you watching for, possible signs of distress?
I'll tell you what, I'm looking at the 30-year. Here's the 30-year. Recently touched 4 down here almost. Intraday, I believe it did. That's at the very bottom. You can see that's where it started the year. If 4% cracks in the 30-year, that kind of brings on the recession scenario. So that's when we're worried about the Fed cutting 100 basis points because things have hit the fan. That's what we do not want to happen. So 30-year, 4%, that's what I'm watching there.
All right, final bullet point, Jared Blickery.
Guess what? The return, the prodigal yen. Yes. So let's go back to Monday. This was when we had the biggest drop in the FX carry trade. And we've gone over this a few times, so I'm not going to go over it again. But it was the biggest disruption, the biggest deleveraging event in the carry trade since March of 2020. That's what caused all of this. And again, it has to do with the difference in the U.S. and the Japanese interest rates. Japan's all the way down here. U.S. is all the way up here. clear. So I think, there's a possibility that this reignites next week.
Well, yeah, I was going to ask you as we ended the weekend, I was hoping you to say, this is all over, right? Rear view mirror? Don't have to worry about it?
I'm a little bit concerned that it could reignite next week. Here's the year to date, and this is a really big drop in currency terms. I'm going to zoom in. I'm going to go over the last 10 days. And here we have 146 is kind of emerging as a key level. That's like right down here. You can see that we've kind of broken this trend line. So we don't have downside momentum yet, but if we develop downside momentum, excuse me, and that would be below 146, then the real level we got to worry about is 141. If that goes next week, we're going to see more turmoil in the markets. It's that simple.
Jared Blickery, thank you, buddy.
All right.
Excellent. Stick around. We're asking for a trend right on the other side.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Anduril Industries making big news this week. The company raising $1.5 billion. It's now valued at $14 billion. Our next guest has been investing in defense tech for more than 10 years. He's a board member at the Council of Foreign Relations. To talk more about the space and how investors are thinking about it right now, we're bringing in Nick Beim, partner at Venrock. Nick, it is great to see you. Kind of bigger question to start, Nick, which is venture investors now clearly more interested, more excited, Nick, about that defense tech space. Wasn't always like that, but it is now. What changed, Nick?
Yeah, I think there's several changes. First, I think there's a boom in the global defense industry generally. We've got wars in Europe and the Middle East. China's adopted a very aggressive military posture toward Taiwan and is trying to leapfrog U.S. military capabilities by investing in tech. And so broadly, the defense industry is booming. Second, and probably most interestingly, it's becoming clear that the character of warfare is changing significantly due to emerging technologies. So I think the future of warfare will be much more driven by AI software and autonomous systems at the edge than by the traditional military platforms that are used today. And that leads to the third change, which is I think venture-backed companies are now best positioned to provide these critical systems, better positioned than the traditional military suppliers. So you've got venture investors very eager to invest in the next Anduril, Palantir, or SpaceX, and that's become a hot space.
These venture-backed startups, though, Nick, ultimately you're competing against these big, entrenched giants. I mean, you think Lockheed Martin, Northrop Grumman. How do they do that effectively?
It's not easy, and the playing field is by no means level. But I would say generally the traditional primes are hardware and services companies. And if you look in the private sector at how many hardware services companies really got great at providing AI or software, the answer is extraordinarily few. It's very difficult. It's very difficult to attract the talent to do that. And if your core DNA is in hardware, it can often be very good to be great at software, be great at AI. Venture-backed startups, on the other hand, are mostly software and AI these days. They're able to attract world-class talent in these areas. So what I think you're going to see more often is partnerships between the traditional primes and venture-backed startups, because I think that's what the Defense Department wants.
These venture-backed startups, Nick, some of them could get acquired. Some of them could try and test the public markets, right? IPO. Do you think there's certain kinds of defense tech startups that are better suited to make that public market debut that you think would be better received by public market investors?
That's a great question, and I do. I think there are generally two types of defense startups. There are those that sell just to defense customers, and there are those that are dual use, that sell to defense customers and the private sector. I think that latter group is much better suited to the public markets because they have much more predictable revenue and a much broader customer base. They don't have the customer concentration of defense only. And it's interesting, if you look at some of the big successes to date, like SpaceX and Palantir, and another company called Dataminer that I'm involved with, they got their start in the military and they got very large based on military contracts. And then they were able to build out very significant private sector businesses. Anduril looks now to be defense only. And I know it's interested in exploring the public markets, but I think generally the dual use companies will have a better time of it.
So it's interesting, Nick, we're talking here about how, modern warfare, the nature of modern warfare is changing, right? Of course, tanks, battleships, critical, but a greater focus now on AI and autonomous systems. How well is the government, the U.S. government, positioned to capitalize on that shift?
I think it's headed its harder in the right place, but it's very hard and it takes a long time to change the system. So my personal view is that the government needs to be much more aggressive in adopting emerging technologies, and particularly in adopting commercial technologies, which have evolved much more rapidly than those in the defense arena. There are a number of new reforms in acquisition and in other areas, and they're starting to change, but I don't quite see the level of urgency that I think we ultimately need.
Nick, such a fascinating conversation. Great to have you on the show today. Thanks so much.
Thanks for having me.
Well, if you're going to future-proof your portfolio, you need to know what is coming up next. In the latest edition of our video series, Next, airing on Monday, we're giving you a glimpse at the future of technology. Austin-based robotics company Apptronik is using high-powered chips and GPUs to teach their humanoid robot, Apollo, through a process called teleoperation.
So go ahead and open up that right hand, pressing down on the joystick.
I'm getting a crash course in machine learning, taking control of the humanoid robot Apollo from Austin-based Apptronik.
Am I giving it too much force?
No, that was perfect.
Oh, so close.
It's a process known as teleoperation. My every movement processed as data to create a mental model for Apollo. Artificial intelligence is supercharging its development, fueled by NVIDIA's ecosystem built on vast amounts of data, allowing humanoids to learn human tasks in record time.
The holy grail for us is what we call zero-shot learning, or the ability to show the robot what to do, and it can do it the same way that you do that task.
Tesla's Optimus is leading a growing market. Backing from big tech companies like Amazon and Microsoft have set new records for funding this year. And it's about to get even bigger, with humanoid robots taking their first steps into the real world.
The latest edition of our series, Next, airs Monday afternoon. Be sure to visit the Yahoo Finance homepage for more. Stay tuned for more Asking for a Trend on the other side. Bad news used to be good news for stocks. Now, good news is good news. Yahoo Finance's Joshua Schaefer joins me now with a closer look. Josh.
Hey, Josh. Yeah, so we're taking a closer look at how stocks have been reacting to economic data, as economic data has been rather in focus over the last couple of weeks. So this is just the S&P 500 here, but Michael Kantrowitz over at Piper Sandler put a little trick on it for us to help us explain how data has been driving this. So what you're looking at again in purple is the S&P 500, in light blue is the Bloomberg Economic Surprise Index. So as this is coming down, that means economic data is surprising economists to the downside. It's coming in weaker than expected. So sort of the trend to highlight here was you can see for a large part of this year, it was coming down, but stocks were going up. The reason for this was the narrative was U.S. economic growth needed to slow a little bit. It was coming in too hot. That was a concern for inflation. Now economists are feeling more confident about inflation, and the narrative has shifted. So right here in this little shaded area you can see here is just when we've had this shift really in the past 2 weeks. You had economic data, specifically this week, with jobless claims come in better than expected, and that is when we got that bounce in the S&P 500. So the key takeaway here being going into a big data week next week, we have CPI inflation, we have retail sales. The market is likely going to be rooting for good economic data, even if that means that we might price in less Fed rate cuts for this year. Right now, people want to be reassured that the U.S. economy is not headed into recession, so any signs of growth has been considered good by the market, at least at this juncture right now.
All right, Josh, you mentioned some of that data we're going to get next week. Dig into retail sales a bit. What are the expectations there?
Yeah, retail sales is going to be an interesting one, Josh, because it jumped pretty big in June. The control group was up about 0.8%, which was a large jump for retail sales. Only expected to increase about 0.2% here in July in that release next week. And I thought Michael Gapin over at Bank of America had sort of a good framing on this. He said, well, if the market wants growth, it might not get it with this print, but it might be okay when you take the big jump in June, combine it with a smaller jump in July. That creates an overall okay picture for consumption. But I guess maybe just a reminder that when this number comes out Thursday morning, you always need to read a little bit more into it, right? It's going to be an immediate reaction on that number, but you kind of have to zoom out and see what the trend is with the consumer. And unless this report really disappoints to the downside, economists feel okay about where the economy is tracking right now for the third quarter.
All right, Josh, thank you. Meanwhile, another activist reportedly taking a stake in Starbucks. Yahoo Finance's Brooke DePalma is here with the details. Brooke.
Good afternoon, Josh. Wall Street Journal just breaking this story that Starboard Value now has a stake in Starbucks. And it's important to note here, this is now the second activist investor that has been on Starbucks back. A few weeks ago, Elliott Investment Management also had a stake, or rather took a stake in Starbucks. And really what we know here is that Starboard Value does or recently secured board seats at Outback Steakhouse, parent company Bloomin' Brands. In addition to that, the company has stakes in Match Group and is also playing an active role in a potential CEO ouster at Autodesk. And what we know here is that Starbucks, this is just one of the many struggles that Starbucks has had in its back. It is facing flagging sales here in the U.S. as well as overseas in China, their second largest market.
The Journal is saying, by the way, the size of the hedge fund stake and its exact demands could not be learned. But let's say, Brooke, they start rattling the cages. Yeah. What changes could they possibly propose and ask for?
Yeah, when I spoke to analysts on the street a few weeks ago when this news broke about Elliott Investment Management, what they really said here is they're really looking for a new reset on value perception. They're really looking to turn around sales in China. And what we heard on the call from Lakshman Narasimhan, the CEO there, is that they confirm that they are having conversations with Elliott Investment Management. They confirmed that those conversations have moved things forward. They also announced that they will have potential partnerships in China. But really, investors here are really looking to turn things around here. They're saying, can you franchise China after we've seen sales decline there? Can we reset value perception? Has Starbucks just gotten too expensive? Do they not have a handle on how expensive that it has become? Another way is they really want to look to enhance the consumer experience. We know that they've been facing, operational throughput. They want their service to be faster. They also want them to make the drinks faster. And so these are some of the many concerns that Wall Street has, that investors have, and now these two activist investors have. And all in the background, you have the former CEO, Howard Schultz, 3-time CEO, also putting pressure on the new CEO, Lakshmi Narasimhan, who took the helm last April. And so it's been quite a year, and all in the background, you have that, although lower noise, but there still is some noise
it's a lot
of those unionizations.
A lot of big names and big personalities. Brooke,
Absolutely.
thank you so much. Appreciate it. That is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.